Hi, I'm Frank Garavello. We're going to talk about convertible notes, a way that you can raise money from angel investors without pricing your stock too early. Rolling. So when a startup company first starts, it's normally done financed by founders' own money, maybe some friends and family. And that, unfortunately, unless you're extremely rich, you're going to have to raise money from people outside of your friends and family. And normally those people, when you're an early stage company, are angel investors. And angel investors, especially here in Texas, love to invest in convertible notes because they get a discount on a future equity round. So now that you're ready to have your company issue convertible notes to the angels, a natural question to ask yourself is, well, what's in a convertible note? In this video, we'll go through 6 key terms in convertible notes so you can navigate them effectively. So the first term we should talk about is your total financing size. So what does that mean? It basically means the money you intend on raising through this round. And the question you should naturally ask yourself is, well, how much do I need? Well, you really determine that by figuring out your projected burn rate, which is how much money you plan on spending on a monthly basis, times how long do you think it'll take you to get to your first equity round. So let's say you intend on raising your equity round in about 12 months, and your burn rate is $50,000 a month. So you take $50,000 times 12 to get a total financing size of $600,000. You then typically should add about a 25% buffer on that in case it takes you a little longer to raise the money, because sometimes VCs like waiting for you to get close to the end of your runway, and then they'll hammer you on terms. So you want to avoid that by having a little buffer there. The next term is what makes convertible notes debt, or one of the items. It's called the interest rate, which is your typical vanilla interest rate. It's normally between 4 and 8%. Any higher than that is a little usury, which is a fancy legal word of saying excessive. If you see compounded interest or interest over 10%, I would say that is a red flag. The maturity date is the other term that makes convertible notes debt. It's essentially the time you have to pay back your loan or convert that loan into equity. It's normally between 18 to 24 months. Sometimes you see it as long as 3 years. That's really friendly for founders because it gives them a long time to get to that next equity round. Most note holders actually won't call their capital if you pass the maturity date. What they're really looking for is the upside in your equity. So you can typically negotiate an extension on that date for another year if you're friendly with them and let them know what's coming up. Next up is the qualified financing threshold, which is basically the amount of money you have to raise to convert the notes into preferred equity. I typically ask my clients to try to have the number as low as possible. So if they can get away with $500,000, great. If not, around $1 million is where we start pushing back a lot. Investors want a higher number because they want to make sure that you raise enough money to get to that next point, meaning a Series A, if you will, or a Series B if you raise a Series A in your next round. So in short, investors like a large amount, and then founders should typically want a lower amount. The discount rate is one of the 2 key terms that investors care a lot about. It's essentially the percentage off that an investor gets on a new purchase price. It's normally between 20 and 30%, although if the market trends downward, that number may hit 40%. And if it goes up, sometimes you see that number at 10%. And how it works is as follows. Let's say the new money comes in at about $1 a share, and your convertible note holders have a 20% discount. They would convert at 80 cents a share into the new equity, not $1 a share. So that's how it works. Lastly, the valuation cap, which is the most negotiated term. can't express this enough. The most negotiated term in a convertible note term sheet. Essentially, it works as follows. It's a cap, if you will, you can't go over, as to the valuation of a company and how the convertible note will convert. So let's say you have a convertible note with an investor that's $4 million. A new investor comes in a year from now, the VC that runs your Series A, and they put you at a pre-money valuation of $8 million. Your old convertible note holder will not convert at $8 million. They'll convert at the 4 because there's a cap. Therefore, let's say the new money is $1 a share. Since 4 is half of 8, the old money will convert at 50 cents a share. And typically, the discount rate plays with the valuation cap where the note holder is able to have the lower of, right? So if the discount rate is lower, they'll get that price. If the valuation cap price is lower, they'll get that price. So generating a term sheet is the first step you could take in raising the convertible note round. Before you do that, you should consult with an attorney to help you out.